Hi, this lesson is a continuation to the previous course on continuation patterns. Take that course first before you start on this one. Now in this lesson, we will explore reversal patterns, case studies, and the types of reversal setups. Let's begin by understanding what a reversal pattern is. Now I want you to understand the essence of why it works. The pattern itself may change in the future, but the essence really won't. When markets are in an uptrend, they might face constant selling at, say, this area. Markets go down again, people buy, and then we climb back up, only to face more selling, and then we fall yet once again. Now, what does this tell you? Common sense tells us that investors are not willing to pay more than rupees 100. There is constant supply at this area. In fact, we see an overwhelming of sellers at this point that the market actually has to reverse. This is simply a reversal pattern. It's how we technicians gauge demand and supply. You can see this in a real example of Dr. Reddy's. The market tried to cross this point 3 times. The price was rejected, and what followed was a huge fall. Notice reversal patterns like this, especially on the daily chart or the weekly chart, can take weeks if not months to actually form. We're not really looking for a magic setup or a magic pattern. We're really looking for what the investors are largely doing in a demand or supply area. In this case, in Dr. Reddy's, it's pretty clear. At around 4,400, the market will always turn around because there are a lot of sellers. And eventually, after some time, the market actually reversed and we got a huge fall. And this is the essence of what a reversal pattern actually is. The market moves in one direction, then fails to continue to move. It attempts to break out several times but fails, and the trend reverses. Let's see the same example, but this time instead of an uptrend, we look at a downtrend. This is TVS Motors. You'll see that we were initially in a downtrend and we tried to move up only to fall down. Now what I want you to bring your attention to is this area. At about 215 rupees, we constantly tried to break down. But when we would reach that point, investors clearly bought, bringing the markets back up. And even here, you can see markets' huge buying power, evidenced by the tails, after which we got a nice uptrend. Reversal patterns is crowd behavior on the charts that signals the reversal of the current trend. Now, this is very important. You cannot use these patterns in a sideways trend because no trend exists. You have to use this in clearly uptrending or clearly downtrending markets. I also want to introduce the types of reversal patterns. The first is the double bottom and then the double top. The double bottom obviously exists in downtrending markets and the double top in uptrending markets. They both reverse the current trend. Then we have the inverted head and shoulders and the head and shoulders. Now the inverted head and shoulders exists in downtrends and the regular, the head and shoulders, exists in uptrends. Now I know they have funny names. Why would a pattern be called head and shoulders? Well, simply because it looks like one. You have a left shoulder, a right shoulder, and well, there's the head. But clearly, that's not the reason we're actually buying or selling the stock. The reason is pretty simple. In a head and shoulders pattern, the market tried to break out 3 times and failed. As soon as the neckline breaches, which you'll learn in just a bit, that's when we know that the supply was enough to push the markets down. Basically, the market moves in one direction several times, and because it keeps failing, we know that something is not right and the current trend may reverse. In the next lesson, we will explore this in more depth.